The haven bid on gold can come off, albeit temporarily, for most bulls as the precious metal ran up to historic highs in the past week. Well, with us now for a deep dive on all that glitters is Aaron Tsai, consultant at First Metro Securities. So good to see you, Aaron. Thank you so much for being here and welcome back to the program.
Hi, Kathy. Thank you for having me here.
All right, let's start with gold because 7 days last week, same time last week, we've seen gold rally to highs that we hadn't seen before at 4,381.21 ounce. That's just amazing. We've never seen that before. What now for gold, given that U.S. stocks have rallied on account of U.S. CPI that reinforced that there might be more Fed rate cuts down the line?
Well, for now, we have seen the gold prices already starting their consolidation. No? The gold is already up more than 100% from the breakout from the most recent consolidation.
Well, let's take a look at that because it's just been an amazing trend that we've seen, and it's back to the mean, something that you've constructed. But what really took my interest here are the moving averages, the MACDs, where we can see that it's, whether it's overbought or oversold, super overbought. Look at that. But then people just kept buying. Tell us more about this chart.
Actually, if you look at this chart, this is an MACD, although I tweaked it a little bit to show the distance between the price and the moving average. So if we can look at the red bar chart here, we can see that the distance between the price and the 100-day moving average has really gone higher than any point in history. And again, that is telling us that the bullishness that is prevailing in the gold prices now is really off the charts.
It is, but it's just respected that 100-day moving average. If I could just point out this red line here, never been broken.
Yeah.
But what if it does?
Yeah, so that's why the current play, at least for the short to medium term, is that because of these excesses, we are expecting some pullbacks, preferably to not hurt the bullish sentiment on gold too much, preferably still above or bouncing off those 20, 50, and 100-day moving averages. But of course, nothing stays forever.
Nothing does.
As we have seen, the 100-day moving average, the red line here, has been supporting every dip of gold prices historically. But if we see the gold prices plunge and go below the 100-day moving average, then we know that we are not in the same trend anymore.
Right, like what they say, whatever goes up must come down. Yeah. And it gets more interesting when we take a look at the gold-linked stocks. And we're taking a look at the mining and oil counters of the Philippine Stock Exchange Index. If we could reveal that, we're seeing a very interesting formation. And this formation, in fact, is quite the extended fifth of the extended fifth. Yeah. I thought that was a typo error, but it's not, like you tell me. With the 3 question marks there, what does that mean?
Yeah, actually, for the previous chart is showing us a daily chart. So it's telling us that it's still possible for the gold price to still go higher if it manages to respect the respective moving averages. But if we look at the full context of it, again, this is a 6-month frequency chart for gold prices. And if this chart is done right, then we can see that it has already somehow completed the requirement 5-wave structure and Elliott wave. And we have seen that from the bottom of the wave 4, we have seen a very significant run-up. That's why we're calling it an extended fifth. And even with the recent run-up that we are seeing, that we see that the over bullishness of the market is present. And as we know, when there is an over bullishness, especially if the market is going to the levels of the general public consciousness already, then it's possible that that excesses might produce some corrections at the least.
True. I know when you see a lot of the people buying gold in the jewelry shops, then we got to talk about gold from this perspective. We dug up more data. The team dug up more data way back to when, I don't think you were born then yet, 1979. Gold on track for its strongest annual performance since the late 70s. Well, I was born then, but I wasn't watching gold, but I wanted to overlay that with the mining and oil counters. Let's take a look at that formation that I was mentioning here. This is very striking, and it interests me because it's the head and shoulders formation that a lot of the technical chartists watch. What does it actually tell us now with the rally that we've seen in gold like we hadn't seen it?
Yes, actually, this chart is showing us the PSE mining and oil index. No, so we have been tracking this for years now. No, because it's very interesting that from the 2020 bottom, it has rallied strongly. That it managed to erase all the drop that it has done from this leg. No, and more interestingly, the recent upfront of the gold prices has pushed this mining and oil index chart to make a higher low, no? Which again is a bullish signal. No? So what happened recently was because 60% of this mining and oil index is comprised of gold miners like APX, OGP, and of course the Philex mining. The run up has challenged the resistance or the neckline of this head and shoulders. And recently, last week, actually, it broke above the
Let's
neckline
take a look at that
already.
breakout, the breakout on the neckline, because it's just so stark. And it's something that you don't really see this all the time. I mean, maybe crypto,
Yeah.
but not even close. Tell us when that breakout happened, and did you expect it because of that head and shoulders formation?
We have been keeping track of this. No, this is a very long consolidation. No, this is more than 3 years of
So
consolidation.
if anybody held on to gold right from the pandemic, at the start of the pandemic, and held it on till Monday of last week, then they made a real big buck.
Yes, definitely. No,
Wow.
again, it's as based on this chart, we are seeing an upside of more than 100% from the breakout from March 2024.
Okay, well, let's take a look at the stocks that it did impact. A glorious ascent, as we've seen, with Oceana Gold. My goodness, it's just run up so much. A glorious run up there, but then again, a glorious run down, that descent, because we've seen gold prices already fall from last week.
Yes. Most of the time, when we see chart doing like this, no, almost a vertical price movement, no. Actually, in the case of OGP, it has been supported not just by gold prices, but also of the very high dividend yield. No, it has come to a point that this counter is actually giving investors more than 10% yield. No, as the gold prices are going higher. No, so not only is the underlying commodity, which is gold, no, providing some support for the uptrend, no, but also the excitement and, of course, the safety from the yield that OGP is giving its investors.
All right, speaking of safety, let's take a look at the next chart, because this feels like a pretty dizzying ascent there. I haven't seen it gone down, and you do cite a breakout. What's happening here if it's not the kind of play that we're seeing in Oceana?
Yeah, from this at this point, well, Oceana is a different thing. No, Oceana is a new IPO, no, a new stock in the market, and it has really gone higher again based on those factors, no. Whereas the mining sector, the mining stocks like Apex and Philex Mining has been in a downtrend, no, for the long time, no, and now they have resurged. Now they have resurfaced, no, so to speak. And if you look at the chart of Philex and Apex Mining, they actually managed to break above their historic highs already, their major resistance level, not historic highs, but major resistance levels. But then again, if we correlate it with gold prices, definitely they follow the cue of the gold price, no. And if we are anticipating some cooling, no, in the gold prices, then we do appreciate some, at the very least, retest of the previous resistance broken by Philex as well as APX.
Well,
Mining.
JP Morgan isn't seeing any cooling, because this is what they're forecasting. Gold prices averaging $5,055 per ounce by late 2026. I mean, if you take a look at the charts that you have, and let's take a look at the next one. I know that you've gone a long way back to the 70s. What does it say?
Well, this chart is actually telling us, now this is from subotrade.com, this chart is showing us that every time that the gold has run up for 9 weeks, the gold prices tend to go lower, no. And again, on the average, a month later, on the average, it has gone down 11%, no, which is consistent to what we're seeing now. So from the 4,380 high to the 4,000 recent low, around 4,000, it's already an 8% drop, no. And from where we are now, we do anticipate some rally, no. But from the structure that we see on the chart of gold, we are still anticipating another leg down, no, which we think could go at least around 3,800.
All right, well, let's take a look at your recommendations to wrap all this up and make sense of it all. What are your recommendations, and what sort of timelines then?
Yes, for now, based on what we're seeing in the chart now, from the hourly chart, daily chart, and again, the context, the long-term chart, we think the gold has run up so fast, and has gone too far, no, from its respective moving averages. So I think there's a case for lightening up on gold. Now, we have been making so much money already from gold, no? So maybe it's time to realize those gains. But from where we are now, we are still at the foot, no? We are still at the foot of the drop, no, from the 4,380 high, no? So what I think is a better strategy would be to wait for a rally, which we do anticipate to go at around 4,200 to maybe around 4,300, no, sell at those levels, and then wait for a proper basing, no, before we re-participate, no, in the gold play.
So for those who bought jewelry, gold jewelry, what do you recommend? Sell it now or hold?
Well, for those who bought the gold jewelry, I hope, no, I hope it's for a bigger purpose, no, maybe to make someone happier than they usually are. No? But it's the different thing, no. When we do financial markets investing, especially even in precious metals like gold, no, we are very much subjected with the emotions and the sight, no, of a red in our portfolio, unlike in the still glittering gold in our cabinets.
Exactly. And that's why we talk about that. Thank you so much, Aaron, for making sense of it all. Much appreciated.
My pleasure.
Aaron Sai of First Metro Securities.